then the question becomes, can I claim that tax loss? By default, rental activities are passive, and passive losses in excess of passive income cannot be claimed. They get suspended and they get carried forward.
This week's podcast is brought to you by Spartan Invest. Spartan currently manages hundreds of turnkey properties across Alabama and Tennessee, and is where I personally bought my first out-of-state turnkey property. In fact, I have 2 properties with them now, and both tenants just renewed for another 2 years. That should tell you the quality of their team and their due diligence. If you are a first-time investor or are looking to expand your real estate portfolio, check out SpartanInvest.com.
Are you tired of the 9-to-5 lifestyle? Do you want more freedom to do what you want, when you want it, without sacrificing your current income? Then this is the show for you. Every week, we dive into John's journey towards financial freedom and everything he has learned since 2014. Real estate investing, cryptocurrency, stocks, private lending, foreign residency, tax saving strategies, infinite banking, assets protection, and much more. Now, here is your host, the founder of the Wealth and Freedom Nexus, John Rickgarn.
Good morning, afternoon, or evening, depending on when you're listening to this. This is John Rickgarn, your host, as always, of the Wealth and Freedom Nexus podcast. This is your first time here. Be sure to hit that subscribe button so you never miss an episode. And if this is not your first time, welcome back, and thanks again for joining. Now, so far in this podcast, we have discussed a couple episodes on real estate turnkey companies, like in episodes 2 and 4. We also discussed pretty in depth of how to get financing for your real estate investments, such as in episodes 20 and 24, or excuse me, 20 and 22, and even short-term rentals with the Airbnb VRBO boom, shall we say, in episode 24. But amongst all that, there is one classification that many investors try to get, and that is the real estate professional status. Now, maybe this is the first time you've heard this, and you're asking, well, what is that? Why should I look at it? Why would it be necessary? So with that, I actually brought on Brandon Hall as my guest today from the Real Estate CPA. And if you haven't guessed from the name, it's a CPA firm that specializes in real estate. So with that,
straightforward.
Welcome to the show.
Hey, thanks for having me on. I appreciate it. I appreciate being here.
Yeah, thanks for coming on. So maybe Brandon, just for some of my listeners, maybe this is the first time they've heard you or heard about you. Maybe you can just give a brief intro on you, your firm, and how and why you got into real estate.
Yeah, so I started the firm back in, I think 2015 was my official first year, but I netted like $4,000. So sometimes I don't count it as my first official year. Yeah, so 2016 was my real big year, gotcha. First year in business. 2016 I went full time into the business. So prior to that, I was kind of moonlighting, working a W-2 job, and then doing this on the side. But I got into real estate. I kind of got into it because I was asking questions on biggerpockets.com. I was trying to buy my own investment real estate. And then I saw a bunch of people asking tax questions. So I just started answering those tax questions. And it sort of just snowballed into creating the firm, or at least getting started there. But I kind of committed to real estate, or providing tax services to real estate folks, because I wanted to see if real estate is truly a great wealth building tool, right? Because like people always will try to sell you stuff and everything, sure. But I wanted to see the actual numbers. So I figured what better way than just to provide everybody tax services so that I can kind of see behind the curtains, and can confirm that real estate's an amazing wealth building tool. So I went all into it myself, and then just started doubling down on growing the firm out. So today we have 33 employees across the United States. Oh, wow. We have around 800 clients across the United States. We're kind of getting into the big firm territory, I guess mid-sized firm territory, and we only work with real estate investors. So provide tax and accounting services, planning services, preparation services, monthly bookkeeping, CFO services to real estate investors, syndicates, and funds.
Okay, very good. So, I might have to look in the bookkeeping services myself. I still do that on my own. I kind of like doing it, but eventually, it just takes up too much of your time at some point.
That's the thing, man. Come on over. It takes a lot of time. And typically we're able to get get some good reporting down that makes you feel comfortable
Sure.
offloading. Because a lot of people, myself included, for the longest time, I was doing this. I used this budgeting tool for my own CPA firm, right? Up to the multi-million-dollar mark. I think we were at $3.5 million in annual revenue before I finally said, I can't do the budgeting thing anymore. But what I realized through that process was there were only like a couple key things that I wanted to see that I didn't realize that that's the reason that I was doing this monthly budgeting thing. So if instead I can just find somebody that can provide me with those 2 or 3 key metrics that I'm interested in, then I don't need to do all the other work instead. So that's what we try to do with our real estate investors is, what are you really interested in? Why are you doing the bookkeeping? Like, really think about it. What are you trying to see? And typically you can outsource that.
All right. Good to know. So,
yeah.
All right. Well, Brandon, obviously the big topic of today is the, real estate professional status. I myself have not one, at least not yet, but I know of other investors that say they are or claim they are, and sometimes just have that as a LinkedIn profile, title, where it might not hit the I.R.S. classification of it. So maybe, high level CPA accounting language, what exactly is the real estate professional status as far as the I.R.S. is concerned?
So at a very, very high level, 30,000 foot view, when you buy rental real estate will generally produce tax losses thanks to depreciation. So even though I have positive cash flow, I get to claim an annual depreciation expense, and that expense will typically exceed my cash flow and create a tax loss.
Okay.
I get to claim this depreciation expense because my building falls apart over time. So even though it's true that the market value increases over time with real estate, it is also true that the roof literally falls apart. The windows literally fall apart. So depreciation expense is meant to track that deterioration. So I get to claim that depreciation expense every year. It will typically exceed my cash flow. We can do things to make it exceed cash flow. We can front load depreciation and really make it exceed cash flow. But anytime my depreciation expense is going to exceed my cash flow, I end up with a tax loss. Okay. And then the question becomes, can I claim that tax loss? By default, rental activities are passive, and passive losses in excess of passive income cannot be claimed. They get suspended and they get carried forward. Now, passive income is any trade or business where I don't materially participate. So let's say I invest $100,000 into the local hair salon. They need capital for expansion, and they give me $10,000 of profit every year. Well, that's passive income because I'm not materially participating. I'm not making decisions. I'm not working in the business. I was just the capital guy. Okay. So that's passive income. But my W-2 income, my business income, that's non-passive income. So if depreciation on rental real estate produces tax losses, and those tax losses are considered passive losses, then I can't use my passive losses to offset my W-2 income and my business income. So instead, my passive losses just get suspended and they get carried forward unless, like I said, you've got other passive income coming in, like that hair salon investment or other rental real estate that produces passive income.
Okay. So
the question becomes, typically it's like not a major issue for real estate investors until they buy something that's $1 million plus. Okay. Because once you get into that range, you can do something called a cost segregation study. Sure. And without going into the details of that, it essentially front loads the depreciation expense. So instead of taking an annual depreciation expense over 27 and a half years, I'm going to front load a lot of it. And I'm going to claim that in the first 5 years or 15 years of ownership. But we also have 100% bonus depreciation. So when I make that front loading, anything that I could claim within the first 5 or 15 years, I actually get to claim in year 1, thanks to bonus depreciation. So when I buy $1 million building, I can generally write off $250,000 of depreciation expense in year number 1.
Wow.
Okay. And so then you have the passive losses all of a sudden become a huge question, because maybe that same property produced $20,000 of net income. $20,000 of cash flow. So if I got $20,000 of cash flow, but a $250,000 depreciation expense, I've got a $230,000 tax loss. So now all of a sudden, my question is, can I use that $230,000 tax loss, or is it going to get suspended and carried forward because it's passive? And that's where real estate professional status comes into play. That's when people start thinking about, how do I get around these passive activity loss rules? Because I don't want $230,000 of losses suspended and carrying forward. I would like to figure out how I can reclassify or recharacterize the $230,000 of passive losses and make them non-passive losses. Because if I can make them non-passive losses, then I can offset my W-2 income and my business income, because that is non-passive income. So I've got to basically, like, think of it as like you've got two buckets of income. You've got the passive income bucket and the non-passive income bucket. All of your rental activities go into this passive bucket. And if you don't have passive income coming into this passive bucket, then the losses are just suspended and they carry forward. In my non-passive bucket is my W-2 income, my business income, gain on stock sale, gain on Bitcoin sales. Those are all considered non-passive, even though you would think like Apple stock sales, that's passive, but the rules say that's considered non-passive. So that's all in this other bucket. And then the question becomes, how do I jump my rental real estate activities out of the passive bucket and into this non-passive bucket so that I can use the tax losses to offset my income?
Okay, very good. And just as a quick highlight, I know you touched base on cost segregation, and we won't do a deep dive into that, but any of my listeners that are interested in that, or maybe just happen to buy a $1 million property, feel free to tune in to episode 12 with Yona Weiss, who's also very into the cost segregation space there too. So now, Brandon, two questions I had, and this is just from, my obviously going on Bigger Pockets and, YouTube and other educational things. Now, as I understand it, if you don't have the real estate professional status, if you're married filing jointly, if you're adjusted gross income, correct me if I'm wrong, if it's $125,000 or less, you can deduct up to $25,000 a year in the, passive losses per se. After 125, then it starts to phase out, and 150, it's a hard stop. Like, nope, this is just all suspended for future years. Is that correct?
So what you're talking about is the passive activity loss allowance. It's a $25,000 loss allowance as long as you're earning less than $100,000. Okay. That's modified adjusted gross income. So I could be earning $105K from my W-2 salary, but I can put $5K into a 401k and I can get the full $25,000. You do have to own at least 10% of the activity, and you do have to be making management decisions, essentially. So you got to be actively participating, and you can make management decisions with a property manager. It's a much lower bar than everything else that we'll talk about getting to real estate professional status. But that $25,000 starts to phase out at right above $100,000. So it's not 125. It starts at 100. And it's completely phased out at 150. And in a quick note on that, some of our clients will pick up on this somewhere, like, hey, I can get this $25,000 loss allowance. And the benefit of this, if I can qualify for the loss allowance, if I earn low enough income and I have rental real estate, I don't have to qualify as a real estate professional. I don't have to do anything extra, right? I just get this allowance that I can claim thanks to the tax losses from depreciation, which is really nice. But don't get confused, for all the listeners out there. People get confused because they'll be at like 155K of earnings, and then they'll have that conversation with us. They'll say, hey, I'm going to put $6,000 into my 401k to drop me below 150K so that I can claim the $25,000 loss allowance. But the way that calculation actually works, if I put if I'm earning 155 and I put 6 into my 401k, I'm left with 149, which 149 to 150, that's the remaining amount of that loss allowance. That's $1,000 of income. And the loss allowance calculated on that, it's only $500. So I don't get $25,000 of loss allowance. I only get $500. So it's not just want to impart upon the listeners that this is a true phase out.
Sure.
So you really kind of need to be in the 125 range to make use of it.
Gotcha. Okay. And obviously, be sure to work with the CPA. Everyone's situation is different.
Yeah.
Like you said, bump up your 401k contribution so it dips you below this, and they can use your total tax or passive loss there. So now, I know there's been a lot of changes in the tax code the last couple of years. Is the threshold for real estate professional, as I understand it, you have to do 750 hours or more a year of, quote, material participation. Of course, it's kind of vague as well. But then in addition to that threshold, that has to be more than, say you have a W-2 job. So it has to be more hours than your other job, or a combination of all your side jobs. If you maybe work 3 part-time jobs, let's say, that adds up to, I'm just throwing a number, 1,000 hours a year between 3 part-time jobs. Then you would essentially have to do 1,001 hours as a real estate professional to override that combination. Is that correct still?
Yes, you have it right. And just a quick note, real estate professional status, what that allows you to do is it allows you to move all of your rental activities out of that passive bucket and into the non-passive bucket. So real estate professional status is an exception to the passive activity loss rules. And it allows you to, buy that $1 million property, bonus depreciate it, claim $250K of depreciation, so minus your net income is $220,000 of tax losses. If I'm a real estate professional, I can use the $220,000 of tax losses today to offset my W-2 income and my business income, which will save me $120,000 or so in taxes. Actually, probably a little bit less than that.
This week's podcast is brought to you by Focus Wealth Group. Do you know you need to get life insurance, but don't know where to start or how much to get? Have you heard of infinite banking, but not sure how it works? Reach out to Barry Brooksby and his team. Barry is not only a mentor, but a friend who has helped me for the past 6 years in my pursuit of cash flow and financial independence. Their mission is simple. They teach people how to make money and hold on to more money. Learn more and set up your free initial consultation at focuswealthgroup.com.
But saves you a lot in taxes. So that's where real estate professional is beneficial, because it allows you to use your rental losses immediately to offset all other income. But you are correct. There are 2 tests to qualify as a real estate professional. One is to spend 750 hours materially participating in real property trades or businesses. The other test is to spend more time in real property trades or businesses than you do anywhere else. So I could have multiple real property trades or businesses. I could be a real estate agent for 500 hours, a landlord for 500 hours, and a flipper for 50 hours. So I've got 1,050 total hours in real estate. And then I could, like you said, I could have 3 part-time jobs that are completely unrelated to real estate. They're W-2 jobs. And I spend 1,000 hours in those W-2 jobs combined. Well, I spent more time in my combined real estate activities than I did there. So I would be able to qualify. But that more time in real estate than anywhere else is very often why people with W-2 jobs, full-time especially, you can't qualify as a real estate professional. Even if you do feel like you could, the IRS is never going to buy that you worked a 2,080-hour W-2 job and spent an additional 2,081 hours in real estate. And even if you were really confident that you were going to win in tax court or something, it's like, you battle the auditor, you disagree with their assessment that you can't do both things. You can't work 4,120 hours in the year, and you want to go to tax court. The tax court will also not buy it. So you're not going to be able to justify working a full-time job and qualifying as a real estate professional at the same time.
Yeah. And I know, obviously tax court, I think a lot of it just comes down to documentation. I think there's one case I read, I don't know the court case offhand, but it was like a nurse then actually was able to win in tax court case that everyone was like, oh, you work full-time as a nurse, there's no way as a real estate professional. Well, I think she was single, she wasn't married, and she tracked all her hours, and nights, weekends, holidays, she worked 2,500 hours a year and 2,000 hours as a nurse, and slept somewhere in there, and actually won in tax court case. So I guess there's exceptions to everything there.
There's always exceptions. And there's a couple like that. Most of the ones where they win, they've got a part-time W-2 job, or their W-2 job is quote full-time, but they don't actually work full-time.
Gotcha. Now I'm guessing probably a big benefit of this, and maybe to really get the additional tax savings, is say you're married filing jointly, maybe your spouse is a high-end W-2 lawyer, doctor, professor, etc. Maybe they're making $250,000 or more a year, and then the other significant other is a real estate professional. I'm assuming if one hits the litmus test, all those passive activities become non-passive, flow through the W-2, offset the W-2 and business income. If you are married to someone making $250,000 or more, that could probably be extremely beneficial for tax savings, I'm guessing.
Oh, absolutely. Yeah. So the way that I like to explain it is that if you are married filing joint, so filing a joint tax return, if one spouse qualifies as a real estate professional, then the entire tax return is considered a real estate professional status tax return. And that's really key for people, like you just said, because if I'm working a full-time W-2 job, I'm making $250,000. One, I probably don't have a lot of time to invest in rental real estate and manage the entire process myself end to end. But two, even if I did, I'm probably not going to be able to accumulate 2,080 plus hours. And even if I did, the IRS is still going to audit me and claim that there's no way that I did. So I'm kind of toast if I have a full-time W-2 job, but my spouse could be the real estate professional. If my spouse is staying at home or works a part-time job, my spouse could qualify as a real estate professional, manage our rentals, and collectively we will have a real estate professional status tax return, which means my rental losses can offset my W-2 income. But one spouse has to qualify as a real estate professional completely on their own. So my spouse would have to hit all the hours completely on her own.
Gotcha. Now, I don't know. Obviously, the IRS kind of has some vague language, if you will, of material participation. I mean, it isn't quite cut and dry, like only activities associated with building a property from the ground up or something, extremely specific. Maybe just in your experience, have you seen any like weird examples of, clients, John Smith just tried to be a real estate professional by doing X, but was thrown out by either, due diligence or the tax court?
Yeah. Well, so real estate professional status is one of the most litigated pieces of the entire tax code. We get a handful of tax court cases on it every single year. And behind those tax court cases, there's thousands of audits that never made it to tax court because the taxpayer just conceded with the audit findings, or vice versa. They were able to substantiate the fact that they are a real estate professional beyond reasonable doubt. And the IRS says, okay, look, we're not going to push this any further. We agree. So to answer your question, we have been called in. So back in 2020, I wrote this big guide. It is like a 12,000 word guide on real estate professional status. I cited it all because we were getting fed a lot of leads and prospective clients, and these prospective clients had completely the wrong idea of how to qualify as a real estate professional. And when I was listening to them, I was like, man, you guys are all going to get audited and it's going to be really painful. Like you're going to have a lot of penalties and back taxes. I mean, we were talking about offsetting hundreds of thousands of dollars in income per prospect. So these are kind of higher income prospects that were being sent to us. But they all had the wrong idea of real estate professional. But the problem is when I would tell them how it's actually done, they would get upset. Nobody likes to hear that their idea is not going to work.
Right.
And that was what my role is kind of turning into. And I'm very much like a solutions oriented guy. Like I will sit down and figure out how to make it work for you. But the reality is that with real estate professional status, in a lot of cases, you just can't qualify. I mean, if you are working a full-time job, you're not going to be able to qualify. So I sat down and wrote this 12,000 word guide because I got tired of people getting mad at me when I told them they weren't going to qualify. And then I went on this big marketing campaign to really get it out there. And that guide's been downloaded some like 3 or some 100,000 times. It's some insane amount. But we've sort of like turned into this firm that does a ton of consulting on the passive activity rules as a result of that initial guide and push to get better information out there about what does it look like to qualify as a real estate professional. So to answer your question, yeah, we've seen a lot of weird stuff because we get called in on these real estate professional status audits. And a lot of times the taxpayer loses. Like we get called in, it's like, we can't do anything at this point to help you. You're being audited for what you did 3 years ago. You're not going to be able to go back and remember the details in any significant manner. And so you're trying to, like, a lot of these people did not record time logs on an ongoing basis. So they're trying to recreate it under audit, and the auditor knows that you're recreating it. And that's just a really painful process. But then when you are recreating it, you're putting all sorts of time down that's not actually going to count for real estate professional status. Like we're putting down education and research time, travel time, investor level time. All the time we see people lose on this type of stuff. And it blows my mind that there are CPA firms out there that still push that, yeah, you can count your investor level time, or you can spend 500 hours of materially participating in 250 hours of investor level time, or you can count your research and education time. The time that you go to the Bigger Pockets event counts. No, it doesn't. None of that time counts. And the IRS is never going to allow it. And we know, because we're sitting there helping people out on these audits, and they lose almost all the time because they're recording that type of stuff. So yeah, I think that there are numerous examples in the tax court where people have recorded just whack time. There was a person that recorded 25 hours in one day, right? And so the prosecuting attorney is like, "Well, wow, that must have been a big day," right? Yeah. There are people that record 56 hours to replace a toilet. Yeah. 1 hour to review an email that consists of like one line. It's like, "Hi, John, I'm happy to be on your podcast next Tuesday." And you would put down in your time log that took an hour for you to review. So it's those types of things that just shoot people in the foot. Sure. But you're doing it to yourself. So the way to avoid all of that is to simply record a time log, record your time as you're doing it on a daily basis. And a lot of people go, "Oh my gosh, I don't want to do this on a daily basis." But the reality is that it's just super easy. It's super easy. You get Google Sheets so that you can put it on your phone, and you just put the date, the property that you worked on, what you did, and how much time you spent. And you don't say, property A emails 1 hour. You would say, "I emailed John about the podcast 6 minutes," not an hour. Because that type of stuff will happen. Like the IRS is going to try to discredit you if you ever go to tax court. And so they would say, "Hey, Brandon sent John an email and he said that it took an hour, but look at the email. Yeah. It's one sentence. There's no way this took an hour. So we can't trust anything else in the time log." And that typically happens whenever people are trying to retroactively build a time log, because they don't remember. And they'll just say emails for 300 days and 1 hour for 300 days. Yeah. It just doesn't work like that. So.
And I'm guessing, IRS specialists and, court case workers, I'm sure they're humans. They might give a little leeway of like, "Oh, okay, a professional plumber could get this toilet replaced in a half hour. This do-it-yourself person, okay, I could see him taking 2 hours, but probably not 56. That might be stretching it a little bit."
Yeah. When I read that case, I saw 56 hours to replace a toilet, and I was like, "Yeah, I would take 56 hours to replace a toilet." But then I really started thinking about it. I was like, "No, 56 hours is a really long time to replace anything. That's a week and a half of actual work,
Well, I was trying to think. It's maybe they're in the middle of nowhere in Montana. The nearest Home Depot is 2 hours away, and there's 4 hours to. I don't know. I could probably stretch it to 10, but that's a stretch there too. So.
Yeah.
All right, sounds good. And then I was just kind of curious, and I don't know, not to name any names or throw anyone under the bus, but I've come across some people that they're like, "Oh yeah, I'm a real estate professional. I get all these tax savings," and just from what they describe, I kind of question if they actually would. Now, you had mentioned, agent hours, and like myself, I'm a real estate agent as well, among my many other hats that I wear. But, if I was able to log documents, I'm just throwing out numbers here. I spent 500 hours last year, driving to showings, open houses, driving around with clients, helping them prepare offers, etc. And then on, say, another hand, under John Rickarn Properties, I have 4 properties that I, manage the managers or manage some on my own. Could I group those two activities together and that would qualify as real estate professional status, or is there a little more to it than that?
Yeah. You can group your real estate. Well, so yes, purposes of testing the 750 hours and more time in real estate than anywhere else, you can group all of your real property trades or businesses together. So you can group your rental property, you can group your agent business, and anything else that you do. If you start flipping or wholesaling or anything like that too, you can group all of that together as well. Gotcha. So you can group it all. Now, you brought something up on the travel time. So the time that does not count for sure is education and research time. Gotcha. So any amount of time that I spend on realtor.com looking for my next rental property is not going to count. Any amount of time that I drive out to a rental property and underwrite it and inspect it and all that type of stuff, that's not going to count, with the caveat that if I close on it, I could potentially count that time. Okay. So education research time, not going to count. Investor level time, not going to count. Investor level time is when I'm doing the books, the bookkeeping, the accounting. I'm paying the bills. I'm filing my tax returns. I'm coordinating with closing people, closing attorneys. I'm coordinating with. I'm doing the underwriting of property, even when I do close. I'm coordinating with closing attorneys, mortgage brokers, all that type of stuff. Anything that an investor would do, that's considered investor level time. That does not count unless you're involved in the day-to-day management of the property. So if I buy a rental and I've done all of this research time, all this investor level type of time, and then I self-manage it, then the investor level time can count. But a lot of people fall into this trap of doing all that work and then putting a property manager on the property. And so then none of their time counts. And then the last bucket of time that does not count, with the asterisk for a caveat, which I'll explain, is travel time. So travel time has historically not counted, with the small exception of localized travel. So if I have a local portfolio that I am self-managing and I'm driving around to those rentals multiple times a week, the travel time can count. I should say transportation time can count, because I think it's a little bit different, kind of a different vibe. But in your case, you mentioned, I'm like traveling around to all these showings. I would say in most cases that transportation time will count as real estate agent activities. If you're traveling 3 hours and it's totally outside the norm, then that's probably not going to count. But yeah, I mean, anything that you're doing locally where you are for sure selling property or helping put together buyers and sellers of property, then that travel time will count for you. It's just not going to count for the landlord that has to travel, beyond. There's no bright line test, but there have been tax court cases where even like an hour and 15-minute drive doesn't count.
Okay, gotcha. So in my example, like I have a vacation rental condo down in Arizona. If it takes me, I think it's like 25 hours to drive down there, I fix the toilet myself, and hey, it did take me 2 hours. I can prove that, but I can count the 2 hours, but I can't count the 50 hours round trip time. Is that correct?
Right. That's correct. And that's true even if you're flying down there. And one that you can look at if you've got vacation rentals is a tax court case is Lucero versus Commissioner. It dropped at the end of 2020. I believe it was September 2020. But that was the issue with them, is that they visited their properties 8 times a year, drove an hour and a half each way. Tax court denied that travel time.
Gotcha. Okay. So, well, and I suppose, someone could look at it too. It's like, well, why'd you waste, 4, 8, 24 hours of your day when you could have just hired a local handyman to go and fix it, and probably look at it that way. And it's my guess, but
yeah, it's more about like the travel time doesn't actually make the property go.
Sure.
Like the time that you spend in the car driving down there is not really helping your property. You're helping your property once you're there,
right?
But traveling down there isn't doing anything for your property. That's kind of the way that it's looked at. And that's why a lot of people, when I first wrote that guide back in 2020, they were like, well, I listen to all these podcasts, I go to all these real estate meetups, but none of that time actually helps your property move forward. It doesn't help it operate. It doesn't make it go. Gotcha. You're improving your skills, sure, but the property's still going to collect rents and the bills are still going to be paid whether or not you listen to the podcast.
Gotcha. All right. So maybe high level, just make sure it's actual activity in, on, under, between the property, so to speak, physically there in the property. And any questions, talk to a certified CPA that can help you out. So you mentioned this guide that you've had with 300,000 plus downloads. Would you be able to email that to me after we record this, and I can put that in the show notes?
So I can give you the link.
Oh, perfect.
Let me see where it is. So it is let me just Slack you or chat you on Zoom here.
Sure.
Sorry, I know that we're creating.
And for those listening, issues. I'll have this in the show notes. If you're, there we go. Listening to this, I'll have this in the show notes on a later time. Perfect.
And if you don't go to the show notes for whatever reason, you should always go to the show notes. But you can go to our website, therealestatecpa.com, and click on resources, and it's right there. It's a guide to real estate professional status.
Perfect. All right. Sounds good. All right. Well, as we get close to wrapping this up here, Brandon, anything I maybe should have asked that I didn't, or anything you can think of that I get asked this all the time that I'd like to let your listeners know about?
No, I mean, I think that we covered real estate professional status at a high level. Again, the benefit is that if you do qualify as a real estate professional, your rentals can be non-passive, which means that I can buy a rental property and I can use the tax losses to offset my W-2 income or my business income, or my spouse can qualify as a real estate professional. And we can do that.
Okay.
So it's very lucrative. And I guess the one reason that I would say this is important, because sometimes people will look at real estate professional status, and they'll when you really know real estate professional status and how it works, you get a little discouraged because it's hard to do, right?
Sure.
It's not something that's easy, and it's meant for people that are in real estate full time. It's not really meant for people that are earning high income non-real estate W-2 jobs. And it's also not a loophole. A lot of people look at it as a loophole, but the passive activity rules were invented to stop people from buying rental real estate and using the depreciation to offset their income. So it was there to stop the loophole. And then they give real estate professional status this kind of out for people that are in real estate full time. That's kind of what it's designed to do. So when you kind of learn about it, you really understand it, you get a little disheartened because it is hard. It's very difficult to achieve it. And it's difficult to substantiate, and it's difficult to win audits. So I really try to do a lot of education around, like, this is not something that you just say, I'm going to be a real estate professional, and you do nothing. I mean, you got to take this very, very seriously. You got to get educated on what works, what doesn't work, and how to substantiate it. But it is beneficial, because if I can claim these big tax losses, then the time value of money theory says that I'm going to win big over the coming years, right? Because if you don't claim the tax losses, if you just depreciate over 27 and a half years, you don't do any sort of acceleration, or if you do the acceleration, but the losses become suspended, essentially you're locking up tax savings over a number of years when you should have otherwise received those tax savings today, so that you can reinvest those tax savings today. And the time value of money theory says that $1 today is worth more than $1 tomorrow. Well, you wouldn't, let me explain it this way. I think people that invest in real estate intuitively know I'm not going to leave $100,000 sitting in my savings account, because my savings account earns 0.5%, and inflation these days is 7%. So I'm losing a lot of money, or purchasing power, I should say. I'm losing future purchasing power by letting my 100K sit in my savings account. The exact same thing is going on with your rental properties. You have predefined tax benefits in every single rental property that you own. And so you have to try to figure out how to draw down on those tax benefits as quickly as possible, so that you can turn those tax benefits into actual cash that hits your pocket, and then reinvest those tax benefits as quickly as you can. Real estate professional status helps you do that. But again, it's hard to qualify as a real estate professional.
Sure. Since you mentioned that, just one final question that popped in my head. Is this, the status, I'm guessing you kind of have to, continually re-qualify per se, but is there any reason, like, an individual, just say, I don't know, 1 year, they decide, God, this great investment came up, I'm going to do this fix and flip, or a couple of fix and flips, as well as time it with, maybe I have some suspended tax losses I want to bring in, or maybe, hey, I want to do a Roth conversion before 2026 and convert my traditional IRA to a Roth IRA. Could I essentially, say, I don't know, say time this, maybe plan this, say for 2023, yep, I do these fix and flips, I do all this, I'm a real estate professional for 2023, but 2024, I'm going back to my normal W-2 job, or whatever the case may be. Is that possible, or is it kind of?
Absolutely.
Okay.
Yep, absolutely. Definitely. On that timing note, just something that popped into my head. Your real estate professional status hours do not carry over year to year. So you lose all of the accrued hours on December 31st, or I guess January 1st of the next year. They don't carry forward. So it is calendar year to calendar year. Okay. The other thing to think about too is, or I guess another point of confusion that I sometimes see is people will say, hey, if you do a cost segregation study today and you create a lot of tax losses today, but you don't qualify as a real estate professional this year, that's okay, because once you qualify as a real estate professional, your suspended passive losses will be unlocked. And that's not true. Your suspended passive losses remain suspended, even if you qualify as a real estate professional in the future years. So to your point about the timing, yeah, you should definitely be timing this. Like, I could buy rentals. I could have bought rentals in 2021 and 2022, not qualify as a real estate professional in either one of those years, and I just wouldn't do a cost segregation study in any one of those years. But maybe in 2024, I quit my CPA firm, or I sell it or whatever. And now I'm like just bored. And so I go and become a real estate professional. Maybe my wife has this high income W-2 job. And in 2024, I do retroactive cost segregation studies on the properties that I acquired in 2021 and 2022. And that creates a big expense, a tax loss in 2024. Now that's a pretty complex process, but the idea is that you're right. You can absolutely time this. So.
Okay. All right. Well, good. Well, I think we've definitely done a deep dive and number of things that hopefully my listeners will get a nugget or two on that and maybe apply to their individual situation. If anyone listening to this is interested in learning more, or maybe wants to reach out and utilize your services or your firm services, what's the best way to reach out to you, Brandon?
So I would say the first place to go check us out is actually our Facebook group. We have a Facebook group called Tax Smart Real Estate Investors, and that is at facebook.com/groups/tax smart investors. And people are asking these types of questions all day long in that group. And so myself and my team will jump in and answer those questions.
Okay.
But if you want to check out a relationship with our firm, just go to therealestatecpa.com. And there's a big orange button in the top right-hand corner that says Get Started Today. I would highly recommend that you kind of explore the What We Do page, because it kind of talks about our services and our pricing as well.
All right. Sounds good. And again, for those listening, I'll have all these links from the Facebook group to the web address in the show notes for you to look at a later time. So with that, Brandon, I want to thank you again for your time and appreciate you helping my listeners on how you qualify as a real estate professional.
Thanks, John, for having me on. I appreciate it.
Thanks.
Thank you for listening. Be sure to share, rate, review, and subscribe on your favorite podcast platform. For more updates, check out www.wealthandfreedomnexus.com. Remember, nothing on this show should be considered tax, legal, investment, or professional advice. This show is produced solely for educational and informational purposes. Please consult an appropriate and licensed tax, legal, real estate, or business professional for specific advice for your situation. For distribution or publication rights or media interviews, please contact the host.